Section 4.1 Understanding Dividend Payout Ratio, Strategies for Utilizing Dividend Payout Ratio. 4.1 Dividend Sustainability Assessment. The dividend payout ratio is indeed a useful tool for assessing the sustainability of dividend payments. By analyzing the proportion of earnings a company distributes as dividends, investors can gain insights into the company's ability to maintain its dividend payouts over time. Here's how the dividend payout ratio can be used to evaluate dividend sustainability, retained earnings, and reinvestment. A high dividend payout ratio indicates that a significant portion of earnings is being distributed to shareholders. While this may be appealing to income-seeking investors, it leaves fewer funds for the company to retain and reinvest in its operations. If the company has limited retained earnings or inadequate resources for future growth and capital investment, sustaining high dividend payments might become challenging. Therefore, a very high dividend payout ratio may suggest limited potential for dividend sustainability. Cash flow coverage. The dividend payout ratio should be evaluated in conjunction with the company's cash flow generation. Positive cash flows provide the necessary liquidity to support dividend payments. A sustainable dividend policy should be supported by consistent and sufficient cash flow from operating activities. If a company's dividend payout ratio exceeds its cash flow capabilities, it may be unsustainable in the long run. Analyzing the cash flow coverage of dividends helps assess whether the company has the financial capacity to maintain its dividend payments, profitability, and earnings stability. Sustainable dividend payments are often correlated with a company's profitability and stability of earnings. A company with consistent and growing profits is more likely to sustain its dividend payouts over time. By examining the relationship between the dividend payout ratio and the company's historical earnings, investors can assess whether the company's profitability supports the dividend payments. A high and stable dividend payout ratio, accompanied by steady or increasing earnings, suggests a higher probability of dividend sustainability. Industry and peer analysis. Comparing a company's dividend payout ratio with its industry peers can provide further insights into dividend sustainability. Different industries have varying norms and practices regarding dividend distributions. If a company's dividend payout ratio significantly deviates from the industry average or peers with similar characteristics, it may indicate potential risks or unique circumstances that could impact dividend sustainability. An industry benchmark analysis can help evaluate the company's dividend payout ratio in the broader context of its sector, dividend history, and policy. A company's track record of dividend payments and its dividend policy can also provide clues about dividend sustainability. Companies with a long history of consistent dividend payments and a stated commitment to shareholder returns are more likely to prioritize dividend sustainability. Reviewing the company's dividend history, dividend growth rates, and the stability of its dividend policy can provide insights into the company's approach to sustaining dividends. It's important to note that while the dividend payout ratio is a valuable metric, it should not be used in isolation. Other fundamental analysis measures, such as cash flow analysis, profitability assessment, and industry comparisons, should be considered alongside the dividend payout ratio to form a comprehensive evaluation of dividend sustainability. Additionally, investors should monitor changes in the company's financial health, market conditions, and management guidance to stay informed about potential shifts in dividend sustainability.